bond market. Imagine lending money to a friend, a company, or even the government. In return, they promise to pay you back with interest. That's essentially what a bond is, a loan in the form of a tradable security. Now, imagine millions of these transactions happening every day, with investors buying and selling bonds based on their confidence in the borrower and the overall economy. That's the bond market in action, a vast and dynamic marketplace where trillions of dollars change hands. It's the beating heart of the financial system, influencing everything from interest rates on your mortgage to the government's ability to fund infrastructure projects. When the bond market thrives, it means businesses can grow, creating jobs and opportunities. And it means everyday investors like you and me can grow our savings and secure our financial futures. You might be thinking, why should I care about the bond market? Here's why. The bond market is a leading indicator of the economy's health. When investors feel confident, they buy more bonds, driving prices up and yields down. This is often seen as a positive sign, indicating economic growth and stability. However, when investors are worried about the future, they tend to sell bonds, causing prices to fall and yields to rise. This can be a warning sign of an economic slowdown or recession. From the interest rates you pay on your loans to the returns you earn on your investments, the bond market plays a silent but significant role. It influences the cost of borrowing for businesses, affecting their ability to hire and expand. Simply put, the bond market matters because it matters to your wallet, your job, and your future. Recently, the bond market has been making headlines, experiencing a surge unlike anything we've seen in recent history. Bond prices have been soaring, while yields have plummeted, leaving many investors scratching their heads and wondering what's driving this unexpected trend. Is it a sign of economic strength, a flight to safety, or something else entirely? In this video, we'll delve into the key insights behind the bond market's recent surge. We'll break down the complex jargon into easy-to-understand language, providing you with the knowledge and context to make informed financial decisions. We'll explore the potential implications of this surge for everyday investors like you, examining both the risks and opportunities that lie ahead. Make sure you stay tuned until the very end, as we'll be sharing valuable tips and strategies to help you navigate this evolving market landscape. Let's dive in. The financial world is often compared to a vast ocean, with its own ebbs and flows, its periods of calm and storms. For the past few years, the bond market has been in a state of relative tranquility. Bond yields, which represent the return an investor can expect to earn, have been hovering at historic lows. However, in recent weeks, a noticeable shift has occurred. Bond yields have started to climb, signaling a potential shift in investor sentiment. This upward movement in yields, while seemingly subtle, has sent ripples throughout the financial world, prompting investors and analysts to take notice and ponder its implications. Think of it like this. Imagine you're a surfer waiting for the perfect wave. This is what's been happening in the bond market. A subtle but significant shift that suggests something bigger might be on the horizon. Section 2, decoding the data. Let's dive into the numbers and decipher what's happening. The 10-year US Treasury note yield has risen significantly, even small increases can have a ripple effect in the bond market. A 1% increase can mean thousands in interest changes for investors. Rising bond yields also affect loan interest rates, including mortgages. Section 3. The flight to safety. One of the primary drivers behind the recent bond market surge is the age-old concept of flight to safety. When investors get nervous about the economy or geopolitical events, they often flock to safe haven assets, like US Treasury bonds. These bonds are considered among the safest investments in the world, backed by the full faith and credit of the US government. In times of uncertainty, investors are willing to accept lower returns in exchange for the security and stability of US Treasury bonds. This increased demand drives up bond prices and, conversely, pushes down yields. It's a classic case of supply and demand at play in the financial markets. Similarly, when investors sense an economic storm brewing, they seek refuge in the perceived safety of US Treasury bonds, even if it means accepting lower returns. Section 1. Inflation fears. Fueling DeFi. One cannot discuss the recent surge in the bond market without addressing the elephant in the room: inflation. Rising prices for goods and services, from gasoline to groceries, have eroded consumer purchasing power and fueled a sense of unease about the economy's trajectory. This inflationary pressure has played a significant role in pushing bond yields higher. Investors, wary of seeing their returns eroded by inflation, demand higher yields to compensate for the risk of rising prices. This dynamic is a fundamental principle of bond investing. When inflation expectations rise, so do bond yields. Imagine you've buried a treasure chest filled with gold coins a year ago, hoping to unearth it in the future when its value has appreciated. However, upon digging it up, you realize that while you have the same number of gold coins, their purchasing power has diminished due to inflation. Adding fuel to the bond market fire are the actions of the Federal Reserve, the central bank of the United States. Tasked with maintaining a stable economy, the Fed has a powerful tool at its disposal: interest rates. By raising or lowering interest rates, the Fed can influence borrowing costs for businesses and consumers, impacting economic activity. In response to surging inflation, the Fed has embarked on a path of interest rate hikes. These rate hikes make it more expensive to borrow money, which can slow down economic growth and theoretically help tame inflation. However, these rate hikes also impact the bond market. Think of the economy as a car and the Fed as the driver. The Fed is trying to find that delicate balance of slowing down the economy enough to control inflation without causing a recession. It's not just domestic factors driving the bond market surge. Global economic conditions are also playing a role. The war in Ukraine, supply chain disruptions, and the lingering effects of the COVID-19 pandemic have created a perfect storm of uncertainty, weighing on global growth prospects. When investors become concerned about global economic growth, they often flock to safe haven assets like US Treasury bonds. This flight to safety increases demand for bonds, driving up prices and pushing down yields. It's a classic case of investors seeking shelter from the storm in the perceived safety of US government debt. Imagine a group of hikers caught in a sudden downpour. Similarly, investors are seeking shelter in US Treasury bonds amid global economic uncertainty, even if it means accepting lower returns. So, what do the experts make of this recent bond market surge? Opinions vary, as always, but there's a general consensus that the factors we've discussed, inflation, the Fed's actions, and global growth concerns, are all contributing to the current market dynamics. Some analysts believe the bond market is overreacting, and yields will eventually stabilize or even decline. They point to signs of easing inflation and the Fed's commitment to controlling prices. Others, however, are more cautious, predicting further yield increases as the Fed continues its fight against inflation and global economic uncertainty persists. Think of it like trying to predict the weather. Similarly, financial experts rely on their expertise and market data, but predicting the future of the bond market is an inexact science. The bond market surge isn't some abstract financial phenomenon. It has real-world consequences that extend far beyond the trading floors of Wall Street. One of the most immediate impacts is on interest rates. As bond yields rise, so do the costs of borrowing for everyone, from individuals seeking mortgages to corporations financing expansions. Imagine a small business owner looking to secure a loan to open a new location. A sudden increase in interest rates could make that loan significantly more expensive, potentially derailing their plans. This ripple effect extends to the housing market as well. Rising mortgage rates can price out potential home buyers, cooling down the once hot housing market. The impact of the bond market surge on Main Street is a mixed bag, creating both winners and losers. On the one hand, savers and retirees who rely on fixed income investments like bonds might finally see some relief from years of paltry returns. Rising bond yields translate into higher interest payments on their savings accounts and bond holdings, providing a much-needed boost to their income. On the other hand, borrowers and consumers face headwinds. As mentioned earlier, rising interest rates mean higher costs for mortgages, car loans, and credit card debt. This increased debt burden can strain household budgets, potentially leading to reduced consumer spending, a key driver of economic growth. The bond market surge also creates uncertainty for businesses. For everyday investors, the bond market surge serves as a timely reality check. It underscores the importance of diversification, a fundamental principle of investing. Relying too heavily on any single asset class, even one as seemingly safe as bonds, can expose your portfolio to unnecessary risk. The surge also highlights the importance of understanding risk tolerance. Investors with a low risk tolerance, who prioritize capital preservation over high returns, might find the current bond market environment unsettling. On the other hand, investors with a higher risk appetite might see the bond market surge as an opportunity. Section 4. Navigating the surge, strategies for success. So, how can everyday investors navigate the choppy waters of the bond market surge? First and foremost, don't panic. Knee-jerk reactions driven by fear or greed rarely lead to sound investment decisions. Instead, take a deep breath and assess your overall financial goals, risk tolerance, and investment timeline. If you're concerned about the impact of rising rates on your bond holdings, consider diversifying your portfolio. Allocating a portion of your investments to other asset classes, such as stocks or real estate, can help mitigate the risk of losses in any one area. Additionally, consider short-term bond funds or individual bonds with shorter maturities. By staying informed, diversifying your portfolio, and seeking guidance from a trusted financial advisor, you can weather the storm and emerge stronger on the other side. Section 1. A seat at the table. Amplifying Black voices. For too long, conversations about finance, especially complex areas like the bond market, have lacked diverse perspectives. This lack of representation not only excludes valuable insights, but also perpetuates a system where certain communities remain on the periphery of financial understanding. It's time to change that narrative by amplifying Black voices in finance and recognizing their unique experiences and contributions. Across America, Black financial professionals, from seasoned investors to community leaders, are shaping the conversation around wealth building and economic empowerment. We need to create more seats at the table, inviting Black voices to share their insights, challenge conventional wisdom, and inspire the next generation of financial leaders. Bridging the gap. Financial literacy in the Black community. The bond market's surge underscores the importance of financial literacy in the Black community. Understanding bonds, interest rates, and investment strategies is key to financial freedom. Bridging the gap requires a multi-pronged approach. Start early, incorporate financial education in schools. Community organizations and churches play a vital role. Make financial information accessible and engaging. The Black community has a long and storied history of resilience, overcoming adversity, and forging paths toward economic progress. From the era of Reconstruction to the Civil Rights Movement, Black Americans have consistently demonstrated their ability to adapt, innovate, and thrive in the face of challenging economic conditions. This legacy of resilience is particularly relevant in today's uncertain economic climate. The bond market surge, coupled with rising inflation and global instability, has created a sense of unease among investors of all backgrounds. However, the Black community's historical experience navigating economic hardship offers valuable lessons in financial prudence, resourcefulness, and community support. By tapping into this legacy of resilience, embracing financial literacy, and working together to build a more equitable financial system, the Black community can not only weather the current economic storm, but also emerge stronger and more prosperous on the other side. The bond market's recent surge offers opportunities for Black investors to build generational wealth. By diversifying portfolios and taking a long-term approach, they can secure a brighter financial future. Investing is about creating a legacy of financial empowerment for future generations. By working together, we can create a future where financial security is a right for all. The bond market's recent surge is a significant event with far-reaching implications. The financial world is constantly evolving, presenting both challenges and opportunities. Like navigating a ship through choppy waters, it requires knowledge and vigilance. The insights we've discussed are practical tools for making informed decisions. Stay informed, stay engaged, and seek guidance from trusted professionals. We hope this video has shed light on the complexities of the bond market's recent surge and empowered you with the knowledge to make informed financial decisions. The financial landscape is constantly shifting. Our channel is dedicated to providing you with accessible, insightful, and actionable financial information. Remember to subscribe to our channel, hit that notification bell, like this video, and share it with your network.